You know, it was 2 weeks ago you said the following, and I noted it that day, and I mentioned it on the program, and I'm going to do it again because it was pre-Fed and pre-correction, where you said, quote, people are really out of their minds if they think the Fed is going to raise 4 or 5 times this year and 4 or 5 times next year. I don't see how that's going to happen. I'll take the under. You heard Jay Powell speak. You still want to take the under?
Oh, yeah, for sure I do. You know, I think the comment Sent totally made at the end there, I agree with. The Fed Fund futures, while it ultimately doesn't prove to be what happens, is really the perception the market has in interest rates and what they're going to be like in the future. And I doubt that rates will change that much. I think people got too hawkish. But, you know, I kind of agree with Joe's comments in the end of the day, which is we need stocks to buy and stocks to sell. So we did our year ahead outlook, that note you're referencing 2 weeks ago. We just came out with like 7 buy themes, 5 short themes with the stock ideas. And that's what I've been focusing on with my investors. I don't have an agenda because we write research. We just our agenda is to help our clients make money. And I think that's the main focal point, to be honest with you. I did upgrade last Friday technology from underweight to an equal weight. I do feel like if I look at historical downturns, that, you know, we guessed maybe 80% of the way through this one. The only ones that are really worse are COVID or European financial crisis or great financial crisis. I don't think we're in that situation here. So our view was, okay, let's look at what industries work. If we're 80% of the way through the downturn, through 3 months after, let's look through what signals work. And that leads us to the portfolio recommendation. So I think it's a pretty good time to stop, you know, getting so negative on particularly the growth universe and start to add some there over time.
I'll get to that in a second, but isn't the risk to the upside on rates? I mean, I almost feel like you're in denial about where we are and what the Fed chair had to say. You got a new Fed regime. I mean, they talked about that. They sort of laid the groundwork as well for balance sheet reduction. I mean, look, doesn't that factor into any of the way you're thinking about it?
No, sure it does. And, you know, we look a lot at how markets trade statistically significant or not to changes in perceptions of rates and the reality of it, which signals work. But Scott, remember, you know, there are hockey rinks full of people at all the firms you mentioned who memorize and follow everyone in the Fed and what they do. And they consistently get it wrong about what the Fed's going to do because the Fed doesn't know what they're going to do. My view is the Fed are the smart ones. They have access to all the information. They're not going to raise rates 8 times or 7 times in 2 years unless the economy is awesome. Okay, so let's focus on what matters. What matters is corporate earnings growth. That's what Jim said, and I agree with him. If earnings are higher in 2023 than 2022, the market's going to be higher. You can fight that all you want. I wouldn't. I think what happened here is kind of what's called a garden variety growth scare fueled by excessive hawkishness. And I think ultimately you'll get higher corporate earnings. Now, maybe if we're backing up and being clinical, we'd say, look, the probability 23 earnings are below 22 earnings is probably a little bit higher now than it was. So, you know, that's because the Fed may be a little more aggressive and maybe at the time things are slowing and they get it wrong. Maybe that's possible. But I still think your base case is higher corporate earnings in 23 than 22. And that leaves you with lots of things that you could buy to outperform and make money.